Hey, welcome back. It's Jason Walter here. Mortgage interest rates are at a 2-month low of just under 3% for a 30-year fixed rate mortgage, and they're expected to remain below 4% for quite some time. If you want the lowest interest rate, you'll have to have an excellent credit score. A good credit score is between 670 to 739. A very good score is somewhere in the range of 740 to 799. And anyone with an 800 plus credit score is basically a rock star. I did some research, and according to the Federal Reserve Bank of New York, for people who either bought a house or refinanced their mortgage in Q3 or Q4 of 2020, their average credit score was 786. In order to get the best interest rate for a home loan, you'll need a credit score in the range of 740 to 760 or more. A credit score is basically a report card of how well you manage your money because it demonstrates your ability to pay off debt in time. Just like school, where you're tested based on your attendance and your test scores, the 3 credit bureaus test you every single month based on a number of different criteria that I'll discuss here in just a little bit. For example, if you're irresponsible with money, then your credit will suffer, and that could disqualify you from getting a loan, or you won't get the best rate. A high credit score means you'll get the lowest interest rate when you're buying a house or refinancing, and that will minimize your payment. So in today's video, I'll share my tips and tricks about how to boost your credit score or maintain a high one that can literally save you thousands of dollars. It's relatively easy to do, and it's entirely free. The only thing that will cost you is your time and for you to hit the like button to help support the channel. First of all, it's nearly impossible to raise your credit score very quickly, so be very wary of any companies that claim they can do that, especially if they charge a fee. On the other hand, it's much easier to lower your credit score very quickly. Simply make a few late payments, especially 60 to 90 days late, and your credit score will more than likely fall very quickly. The best thing to do is to manage your money responsibly over time. And when I mean over time, I mean forever. Aww. So to get the highest credit score and the best interest rate, you'll need to do a few things absolutely perfectly. Number 1, pay your bills on time. This is because this makes up 35% of your credit score. So your payment history is the most influential way that affects your credit score. Never, never, never pay your bills late. This includes your phone bill, your cable bill, your auto loan, your mortgage, and so on. For the bills you have to pay every single month, I highly recommend that you set payment reminders on your phone. Or better yet, set up your bills on auto pay and set it and forget it. But pay all your bills in full if possible. If you can't pay in full for your credit cards, then I highly recommend you make at least the minimum payment, which is around $20 to $50 depending on your balance. Paying anything less than the minimum due is a late payment, and you will likely be charged a late fee by your lender or bank, which is often up to $40. Plus, if you continue to make late payments on your credit cards, your credit card company could eventually decide to raise your interest rate. That would make it even harder to get out of debt. And please keep in mind that late payments can stay on your credit report for up to 7 years. If you file bankruptcy, that can stick to your report for up to 10 years. Creditors normally will not report a late payment to the credit bureaus until it's 31 days past due. So you have a built-in 30-day grace period to make your payment before your credit score is affected. However, do not count on this. Pay your bills on time every single time. Your credit utilization, or the amount you owe, is also a critical component. So besides paying on time, you will need to maintain a low credit utilization rate. This contributes to 30% to a FICO scores calculation. Credit utilization is your credit balance compared to the credit that you have available. For example, let's say you have one credit card and has a $1,000 balance on it. However, your available credit is $10,000. Therefore, your credit utilization is 10%. The general rule of thumb is to keep your credit utilization below 30%. What this means is to never utilize more than 30% of your total available credit. So on any given day, your credit utilization should be below 30%. For example, it looks very bad if you consistently use your maximum available credit. If your credit line is $5,000 and you continually utilize $4,800 of it, that will hurt your credit score. Here's a tip for you. Do not close any old or unused credit cards, especially if they have a high amount of available credit, because that will increase your credit utilization rate. Let me share another example with you. So let's say you have one credit card and it has a $1,000 limit. However, you have a balance on it of $1,000. That means your credit utilization is 100%, and that is very bad. In contrast, let's say you have 4 credit cards, each of those with a $1,000 credit limit, and you have a combined balance on those of $1,000. Therefore, your total utilization is 25%, even though you owe the same amount of $1,000. This is why I never close any credit cards that have a high available balance, because it helps contribute to a low utilization rate. Let me share 4 tips to get a low credit utilization rate. Number 1, ask your creditor for a credit line increase. However, do not use this extra available balance. Number 2, pay off your credit card balance multiple times per month. That way your balance and your credit utilization will be minimized. And never go above a 30% utilization rate for any day in the month. Number 3, spread your charges across multiple credit cards every single month. That will result in multiple accounts with a low utilization rate rather than one account with a high rate. And number 4, pay off or pay down your credit card balances that have a higher utilization rate. Another way to increase your credit score or to maintain a high one is to maintain a good length of credit history. This is because this makes up 15% of your credit score. In order to calculate your credit history length, the 3 credit bureaus use your average age of your credit accounts, not your total age. For example, let's say you only have one credit card and you've had it for 2 years. Therefore, your credit history is 2 years. But if you decide to open up a brand new credit card, then your total credit history drops to 1 year. My advice is to start building your credit early. The day you turn 18, get a credit card and use it wisely. Regardless of your age, if you don't get approved for a credit card, you may want to look into getting a secured card, because this helps build and establish your credit history. A secured card, as the name implies, is secured by money that you deposit with the issuer. So in simplest terms, if you deposit $200, then your credit limit is $200. Payments that you make or don't make will be reported to the credit bureaus, and that will help establish your credit history. My 4th tip that I have for you is to limit new credit that's being opened, because that's 10% of your total credit score. For example, it's very bad to open up multiple credit cards in a very short period of time. This is because new accounts lower your average account age. A 5th way about how your credit score is measured is by the types of credit that you have. This makes up 10% of your credit score. There are 3 main types of debt, and that's installment debt, revolving debt, and mortgage debt. An example of an installment loan is a car or student loan, because your payment is fixed. And revolving debt are credit cards, and this is one of the most significant forms of debt because your payment changes over time. Plus, it takes more responsibility to use credit cards because you have a credit balance available to you to spend anytime you want. If used properly, a mix between revolving, installment, and mortgage debt helps improve your credit score over time, because it shows creditors how you manage your money with different types of accounts over time. On a side note, if you're in the process of buying a house right now, then you definitely should be aware that your lender will do a soft inquiry the day of close of escrow. What the mortgage lender wants to know is, are there any new debts that were opened? I've heard horror stories about home buyers buying RVs just before the close of escrow, and at the last minute, their lender denies their loan. Here's something I highly recommend that you do. So go to annualcreditreport.com and order your free credit report from one of the 3 credit bureaus. That'd be Equifax, Experian, or TransUnion. Check your credit report for errors, and if you do find any errors, contact the credit bureau immediately. If you enjoyed watching this video, then please hit the like button. I greatly appreciate that. And also consider subscribing as well. You also can follow me on Instagram. I'm Sacramento Realtor. Hope you have an awesome day and look forward to seeing you on the next video.